Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the collision of big tariff announcements and Jobs Week. I want to thank our sponsor, Optimal Blue, for making this episode possible. Logan, welcome back to the podcast.
What a wonderful Friday morning this is. We have lots of drama, and I myself is an agent of chaos as well, so I kind of live for these kind of days. So it has been a lot of fun. Good for the bond market, good for lower mortgage rates. But today was one of those crazy days with data and stocks are selling off. And we got Liberation Day coming up, Jobs Week coming up. There's so much happening over the next week that it's a wonderful time to be alive in America.
I'm so glad you're enthusiastic about this. Okay, we're recording this on Friday, and this will go live on Monday, which will be the 31st. And then we'll have, just in a few days on Wednesday, we're going to have quote unquote Liberation Day, which is all about tariffs. But we have so much happening next week as well. So do you want to do tariffs first?
Let's do tariff on, and then we'll take tariff off after.
Okay.
How about that? Okay, so it's Friday morning. The inflation data, the PCE inflation report came out today, a smidge higher than estimates, but this was highly anticipated to be a little bit hotter inflation report. So not too much of a surprise there, but the economic data wasn't good. The consumption data wasn't as strong as people thought. The income data was okay, but if the growth rate of inflation is higher, real wages growth we're getting to a tricky stage here. So the 10-year yield fell. And then, of course, here's the thing that we have to start thinking about going out in the future. Let's assume that the tariffs on cars, I know some of it is like a funky percentage on certain things, but let's assume that we have 25% on tariffs on cars, everything. So President Trump last night said, auto industry, you better not raise prices on consumers. I'll be mad. So I thought of like the Twilight Zone, the little kid, bad man. So why would he do that? Because it's starting to creep in to a lot of expectations of the economy this year. I don't really take survey data too seriously, but it's like, if you look at the Michigan survey, it's like the worst. Like, people are worried about their jobs. The inflation is taking off. It's not what you want to see, and it's at very high levels too. So Trump tried to tell the auto companies not to do this. If we get tariffs, don't raise prices. But if they do raise prices and it sticks for about, let's say 3 to 4 months, I'm assuming that the Federal Reserve is going to raise its inflation expectations one more time. It's one thing in 2018 and 19 where you're doing this trade war tap dance on, small items, not a big percentage. You get into the cars, it's people are saying it's an extra 3, 4, some even have 6,500. Well, the problem is it's not like rates are down so much to offset car loans as well. So you're dealing with things that, you got to be mindful of it right now. So the question is, are we going to get a tariff off on Sunday or on April 1st? I'm not going to believe anything that happens on April 1st. So everyone be mindful. Don't get tricked about that. They moved it from April 1st to April 2nd, thankfully. So I thought that was a funny joke. But President just had a talk with Mark Carney, basically Canada saying America's not a reliable partner anymore. So we'll see how the next 48 to 72 hours, but bond yields are falling, right? And you're starting to get to a situation that you have to now make the case that the economy starts to get better with tariffs, which it's not really designed to have like that quick positive impact. One of the reasons I don't believe that anybody believes in tariffs really is because you simply put it in place. You keep it there for like 15 to 20 years and the whole thing changes over time. So now you're starting to see stocks sell off, bond yields go down, mortgage rates are going a little bit lower today. So you're now getting into a little bit more of a tricky stage because we're going into April now. And you can't just say the X economy was a former president. When you start to get into Q3 and Q4 and you put all these policies in place and you fire federal workers, that's your fingerprint. So it's now a becomes a political game. I think the White House took off one of its UN ambassadors because they're a little bit worried about the House. And this is the problem with making big changes. The political cycle is really 2 years, and it becomes harder if you lose people in the House and Senate because of what people are feeling in the economy now.
Okay, so unpack a little bit for me. When you say the inflation, the Fed might have to change its inflation target. What does that mean to the normal person out there? Does that change the rate? What does that mean?
Well, here's the thing. The Fed raised its inflation targets for the year, and yet the 10-year yield and mortgage rates have gone down because the people perceive Sarah, what is this? What are we talking about? Boom, boom, boom. Labor over inflation, right? And the bond market believes that if it came to it, everyone's going to flinch, and bond yields go down, mortgage rates go down, the economy gets weaker, labor over inflation. So the Federal Reserve took what we believe we're going to get to 2.1% or something. They raised it to 2.7. Well, if you have like 4 months of a one-time price adjustment on goods with cars, you could probably see the Fed raise their inflation expectations a few months out from now as well if this continues. So then you start to get in a back and forth game, right? It's fascinating because now we're getting to that area, right? You either gotta commit to it or you don't commit to it. But when you go into the trade war tap dance early and people start calling your bluff, you're gonna see this is the thing about at this stage, he's gonna have to do something or people are just gonna say it's all for show. And that if it's something he really wanted, then he wouldn't care. But if that's something he doesn't want really, you get into the era where the Federal Reserve and policy can maybe make an unforced error that they don't want. This is why it gets a little bit more tricky for even the Fed now, because they've said, well, if we raise rates into something like this, it's recessionary. But so it's just a more crazier time in this sense, because you can see it in the public surveys. Like people's inflation expectations are skyrocketing, people's fear of their jobs losing. There's a talk about how many people they look like they want to fire from the federal workers. It's about 800,000 people. If that's the case, is what we've talked about. You're going to get the unemployment rate to rise just based off of that if the labor force growth stays the same. So much is happening, but the response is 10-year yield goes down, not up, right? And mortgage rates a little bit lower today.
I think your point about what you've said all along is like, the White House wants lower rates. We all want lower mortgage rates for sure. And part of that is to offset the, what might be cost more because of tariffs. But as you said, like at what point is that offset? How much do mortgage rates have to fall or rates have to fall to offset tariffs at this point?
When we think about tariffs for housing, it's really the builders. Again, lumber prices were $1,000 higher during COVID, yet mortgage rates were at 3%. So the Federal Reserve obviously doesn't care about the existing home sales market, but the labor market is their concern. And if rates stay elevated or grow higher with tariff costs, the builder's profit margin goes down and, it gets more difficult. We always talk about construction labor is a recession indicator. So you see the complexity now with adding these variables into the equation rather than just like having things be normal. People are prone to make more mistakes when there's chaos, right? Because sometimes you don't know how somebody's going to react or, is this something you really wanted? But for the builders, you could see why the builders wrote that letter. Please give us an exemption out here. And we'll see what, because the builders are kind of right on that margin of completed units for sale. And what this means is that permits aren't going to go off anytime soon in any matter. So that's something we addressed in the last podcast. But now you could see this, that if there is going to be economic weakness before this, the 10-year yield has gone lower. I'm pretty sure the White House probably would love to have mortgage rates in the 5s right now, because with all this headline news, if people are buying homes, they feel better. If there is car inflation in terms of, let's say, $5,000 additional cost, well, if car loan rates come down, you could offset it. You can see why they want lower rates. But here, it's just, we're not there. We're not there on the rate side. We're not there on the Fed side. And who knows what they're trying to do in terms of gaining any kind of access with the Federal Reserve on terms of maybe trying to get somebody to lower rates there. But it starts to all make sense right after the day of the election when Mnuchin said, we would like to have a cap on the 10-year yield. If this game plan is going into fruition and goes on more, it just gets more chaotic with the data. But for now, the 10-year yield has gone lower. The GDP, the Atlanta GDP is negative 2.8%, but if you make some trade adjustments, it's actually slightly negative. So even with the trade adjustments, we are now slightly negative on GDP. You can make a case that the second quarter, you get a rebound in demand because of weather. However, we didn't see that in the report today, and that's one of the reasons why the 10-year yield is down. Stocks are down. So we had this in 2018 and 19, a lot of market friction over this. And it is interesting that the oil industry says, man, we're not building any more wells unless you get oil prices up here, right? Chaos, Sarah, agents of chaos. I'm grinning. I'm happy. This is kind of my world where I like to operate in. But for the American consumer, you could see why these surveys aren't really like, hey, what's all this stuff?
At what point, I know you don't like surveys, but you've noted that, across the board, we're seeing that consumer sentiment get hit. At what point does that start to hit in the housing industry? So you're already, coming off a couple of years where people are like, oh, I wonder if, rates are high relative to where they were. I'm trying to wait, whatever. Like, at what point do you see that measurable in the housing context?
Surveys, to me, housing surveys are somewhat useless because it's the rate factor actually matters more. So here's a really good example. The public surveys on the economy have soured, and yet purchase application data is better this year. Why? Because rates are lower. Now, if mortgage rates were higher and purchase application data was better, you'd be like, what's that about? Okay. But I'm assuming that if mortgage rates had gone up to 7.75, let's say we didn't have that peak around January 14th. I'm pretty sure the data wouldn't look like it did this year. But the thing is, rates went down. So even with all this negative survey, it's a little bit better demand than last year on the weekly data. So I always say, if you wanted to do paper, rock, scissors on rates versus surveys, you go rates over surveys all the time. And again, COVID was the greatest example ever. Like, everyone was talking about depressions. Are you going to live and anything? Literally, when people realize I'm not going to die, oh my God, rates are 3%. Let's get a house. Because you just got to survive to that next stage, right? If everyone's living, then yeah. So surveys are useful for some things, like the builder survey is good for business. But if it really impacted housing for the consumer side, the data wouldn't look like it did this year. On the builder side, the builder survey collapsed, and they'll tell you why. Higher lumber costs, rates are still elevated, profit margins are slowing down, units complete, all these things. For the builders, yeah, but for consumers, so far, consumers are on the housing side are moving off rates, and the 10-year yield is, I think, 4.27 last time I checked, and I think the high this year intraday was like 4.81%. So lower yields, demand picks up. Keep it very simple. Post qualified mortgage, that's been the case.
Okay, we will keep an eye on Monday, what happens. It's going to be very interesting in the tariff on, tariff off.
And now jobs week.
Yes. Okay, so that's my next topic is like labor over inflation. Let's get into that labor data that you're expecting.
So job openings, jobless claims, BLS jobs report, and then we have the ADP report, which doesn't have that much value compared to the other three. Now you get into another interesting aspect. We are firing federal workers. We're withdrawing. The reason I always tell people we're withdrawing money from the economy, that means it isn't just the firing of workers. There's contracts that are out there. That means less demand is coming into the economy. That's what money does. When you put money into the system, it filters itself in the economy. When you withdraw money from the system, it lowers aggregate demand. Sarah, what did the White House counsel tell us? They wanted to lower aggregate demand. What has Jay Powell told us over the years? We want to lower aggregate demand. Everybody wants to lower aggregate demand. But in this case, going out for the rest of the year, if you don't have the government workers being in the pool, then the total jobs data falls. If the total job data falls, labor force stays constant, more people are looking for work. That's the other thing. Labor supply, White House counsel, labor supply, higher labor supply. Jay Powell, higher labor supply. So in this sense, it's designed to cool the economy down. But if you're cooling the economy down and inflation stays sticky, that's not kind of what you want out here. So we'll see how the rest of the year goes, but you can make a case that the unemployment rate was going to go higher, and that's what was our case. And now the Federal Reserve has raised their unemployment rate target. So we start to get into the phase to where we start seeing the impacts of government workers losing, money being withdrawn, and what does it do to the unemployment rate? And so far, the bond market says we need to take yields lower, not higher in that environment, even with the inflation data on the PCE side, at least firming up. But we have two handles still. My God, we still have core inflation on a 12-month basis, two handle headline, still two handle. But it gets trickier now, right? You're trying to like micromanage, certain things. And you could see why President Trump told the auto companies, don't raise prices. Don't do it, man. I'm going to be upset.
Okay, you know what else is tricky is just knowing where people are in that layoff process. So we know that, like, okay, for instance, one of the executive orders a while ago now was like, we want to lay off 50% of HUD workers. Okay, but also then there's a lot of judicial actions that are like delaying that, or they've been put on hold. So it's really hard to tell, are those people employed? Are they on administrative leave? Have they been recalled? Are they still unemployed? Like, it's from the outside, it's very hard to see exactly what is happening with that. Okay,
rule of thumb with the labor market. We always say be mindful of residential construction workers, but if you had to find one source of data line, the jobless claims data line is pretty efficient. There's the continuing claims data line, which has gotten softer, which means it takes people longer to find work. But the jobless claims 4-week moving average has been very efficient in terms of people who are unemployed and need to get that benefits. Now, of course, there's tech executives who have like 1 year severance and, they don't need to do anything. But in general terms, economic cycles still have moved off of 4-week moving average jobless claims. And it has worked flawlessly again. I'm shocked, Sarah. All right. Everyone's like, oh, there's all these jobless claims data and it's really real. People don't apply. And it's 2025. We still haven't had the job loss recession. So we will be able to see it more efficiently from that data line. And we're still historically low. The continuing claims is a little bit more elevated because it takes longer to find work. But in a sense, if you fired 60,000 people and then like 3 weeks later they find work, doesn't really do anything, right? They're still employed. So the jobless claims number historically post-World War II tends to rise on a 4-week moving average, a certain percentage. We always say target that 323,000 level on claims. Don't go into the recession talk until we get there. We're just not there yet on the weekly data. So we'll be able to see it. We saw the jobless claims data really perk up with the federal workers. It's kind of a separate data line, and that has fallen down just a little bit. But you can't hide a job loss recession in the data line. Jobless claims always breaks, and we're just a little bit mindful, but we need to get that upward to really make that claim right now. And everyone else in the last 14 years, outside of COVID, we never had recessionary data. It's been very long for people out there. People talk about it a lot, but we're just not quite there yet.
It's a great point because, like, then it goes down to the individual level. Is that individual level, does that individual feel like they can file a jobless claim? So that's, that's at the point where you've been fired or you're not getting a paycheck or you don't think you're getting back. Like that's a good data line.
So we're a service-based economy. So typically what happens, jobless claims on the lower wage sides of service workers tend to always apply for unemployment benefits, even though it's not the most efficient system in the world, especially certain states are really outdated. It tends to always work. So as long as something tends to always work, you go with it out here. And it's just one of those weeks. And who knows? I mean, we're talking on Friday, maybe Sunday, Trump's in Canada. having, pancakes with Carney or something, they cut a deal or something. We don't know what happens in the future because things could change on a dime. But for right now, you could see, everyone's a little bit more mindful. The bond market's a little bit more mindful, but the 10-year yield has not crossed that key level. People are telling me I need to create a mythical character or a fictional character for this line. I said, no, I'm not going to do it yet. I was going to bring the Witcher involved, but he doesn't really say anything too clever. So let's see if the 10-year yield breaks below 418, 415, and we get follow through buying. We got something there. That means the bond market is sniffing out weakness, or you could say that, the 10-year yield really can't go lower if inflation picks up. So it's crazy, Sarah. I'm telling you, for me, it's fun. But I can imagine for consumers out there, what is going on? Because those survey data are terrible. Like literally, if I took them at face value, this is worse than the Great Recession, worse than COVID, but they tend to be ideologically driven. But the headlines it's confusing out there.
Well, and the people who have to deal with consumers on the front line are real estate agents, loan officers, and the consumer sentiment. I'm sure they're seeing it firsthand.
Yeah, that's why I tell people, I implore people, if you really wanted to find out what's going on, 24/7 Instagram page, those story videos. I do not sleep. I keep everyone informed. I'm an economic cycle person first, housing seconds. I love this stuff. We try to make sense of it, but I would tell you, this is chaos. This is COVID was one of those things where, we were so depressed in economic activity. All we needed to do is be alive, and we're rebounding. 2008 was a credit boom, credit bust, foreclosures, bankruptcies. The deleveraging process took years and years for that to happen. That's different. Here, we're just headline central, right? One day something, you can say something. And, I think Larry Kudlow, who used to be part of Trump's administration last time, he came out and said, it seems like the tariff policies a little bit confused about it. And one week it was fentanyl, the other's a trade deficit, others jobs. So clarity can bring chaos in, but you also have to live with the aftermath of what you choose. This is why I've always said I just don't believe anybody wants to go into a full trade war, because if you really believed in tariffs, you would just, day one, we're going to be here for decades. This is how it's going to be. But so far, nobody's really committed to that. They'll do something, they'll take it back. And, I get if you wanted to make deals off it, that's fine. But the problem with going early and taking it off and on, you got to do something or else you get called on your bluff. And then, yeah.
Well, and Trump loves a marketing thing. So, Liberation Day. So he's kind of branded it now. Something has to happen on that day. Otherwise, what does that all mean?
Yeah, that's why the next few days, we've talked about this for the last, 6-7 weeks. If you go early and you call stuff off and people are calling you on it, you eventually have to do something, right? Or else it's just like you're not serious, and then other countries figure this out. So it's going to be a lot to take in over the next 7 days. So 7 days from now, we'll do that Friday podcast, so we'll see what the aftermath is. But yeah, there's a lot of variables right now that can be very big things, or they could just calm things down. But I get it. I get if you're a consumer or home buyer or home seller, what's going on? This is chaos. And I love chaos. Oh, I love chaos.
You're the only person here who loves chaos.
It is so much more fun this time around than last decade. Last decade was so snore me later. Economic data was so simple, boring, and tangible levels were very slow, not very volatile. But here, right? I mean, who writes a COVID-19 recovery model on April 7th, 2020, when people are hoarding toilet paper and talking about depression?
No, right. Only you. But also, I mean, we wouldn't have this podcast where we have you on 3 times a week if we were in that sort of snore level, because what would we talk about if it was, if we had those
Sarah,
little ranges?
I'll always find something to talk about. Economics doesn't sleep. It might not be the most exciting thing or topic, but there's always something to talk about. But this is getting beyond economics, because it's now tilting on the survey data. It's just on everyone's mind out here. It's not just firing federal workers or Doge doing their things. There's a lot of things. It's not just America, it's other countries as well. So Just think of me as the economic Jack Bauer. That's what I am. I'm 24. I'm the economic Jack Bauer. I'm here to solve everything.
We have another persona coming out right now.
Yeah, that's really what it is. I'm just Jack Bauer 24/7.
Are you going to strangle someone with a lamp? Remember that famous episode where?
Yeah, no, you know what, Jack? This is what I was. I think it was the first or second season where he just asked this guy, "Do you have a chainsaw?" A cutting thing, and he had to like scare the individual, so he like decapitated a head, and then it's mind games out there. But Jack, that was a great series.
That was a great series, especially the first couple. Okay, Logan, thank you so much for keeping it entertaining. We will check in.
Pleasure. As you can see, I'm pumped. I'm juiced. I'm ready to go.
All right. Talk to you soon.